Welcome to Thoughts on the Market. I'm Michael Zezas, Head of Public Policy Research and Municipal Strategy for Morgan Stanley. Along with my colleagues bringing you a variety of perspectives, I'll be talking about the intersection between U.S. public policy and financial markets. It's Wednesday, July 28th at 10:30 a.m. in New York. All week long, investors have been hanging on the headlines about the $600 billion bipartisan infrastructure plan. The concern? That talks could break down and the market might have to adjust to lower economic growth expectations as a result. We're not as worried. In fact, by the time you hear this, the deal could have fallen apart or definitively succeeded. But we don't think that matters much. While the success or failure of this bipartisan plan could be important for political reasons, for investors we think it's mostly procedural noise on the way to eventual approval of a spending plan that will total $4 trillion over 10 years. Why? Because congressional Democrats already have a plausible way to make sure the spending plan is enacted. If those bipartisan talks break down, Democratic leaders have already signaled they would simply add that spending to their planned $3.5 trillion budget reconciliation bill, which is eligible to pass the Senate with only the support of all 50 Democrats. We think that's a viable strategy, as programs whose spending totals up to that number are already supported by all Senate Democrats. And while some key Democrats have vociferously resisted passing the spending plan without a significant attempt at the bipartisan bill, that significant attempt appears to have already happened, since the length of bipartisan negotiations can now be counted in months. So investors would be wise not to conflate the prospects for this bipartisan deal with that of the broader fiscal policy. For us, that means our base case remains on track. $4 trillion of spending, $1.5 to $2 trillion of revenue increases, and thus about $250 to $500 billion of deficit expansion next year. That's real support for continued strong GDP growth in the short term, and likely a challenge for the bond market, where rate strategy colleagues see current Treasury yields well below fair value, partly driven by the lack of faith in this U.S. fiscal policy path. Thanks for listening. If you enjoy the show, please share Thoughts on the Market with a friend or colleague, or leave us a review on Apple Podcasts. It helps more people find the show.
The preceding content is informational only and based on information available when created. It is not an offer or a solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.